Hello, everyone, and welcome back to the Peterson Institute for International Economics. My name is Adam Posen. I'm the Institute's president, and we are glad to have a global audience joining us today for a global issue and a comprehensive discussion of international sovereign debt with private creditors. This, of course, has been one of the seminal, critical, or pick your adjective, recurrent themes of international economic cooperation in the financial sphere and international economic failure to cooperate in the financial sphere, associated with both crises and development going back now more than 50 years. Of course, people will tell you historically this is an issue going back well into the 18th century. But we have had the IMF and the post-war financial system with us for more than 75 years now, and the need for continued reconsideration of how to deal with the composition of public sector debt, cross-border, and private held creditors remains central to the functioning of the international financial system. With that in mind, the G20 had commissioned the IMF and its leadership to address this problem anew, reevaluate their legal and operational frameworks, and come up with a proposal. And we are grateful to the IMF for giving us the opportunity to present and discuss that proposal today. I will get to our leading speakers and discussants independent in a moment, but first I'd like to turn to the first Deputy Managing Director of the IMF, Geoffrey Okamoto. Geoffrey has had a distinguished career, including service in the US Treasury as Acting Undersecretary for International Finance earlier in the Trump administration, and serving in a number of key roles for the critical economic and financial committees in Congress. Mr. Okamoto, over to you, please.
Great. Well, thank you very much, Adam. And let me start by thanking you and your entire team here at the Peterson Institute for International Economics for putting on a great event this morning. It's good to be here among friends, and I see the distinguished set of panelists and speakers behind me, and know we are all in good hands. This event could also not be more timely. We are 2 weeks away from the IMF and the World Bank's annual meetings, where addressing growing debt vulnerabilities is going to be on the top of everyone's minds. Now, the IMF has been doing a lot of thinking on this issue, and today we are releasing a paper on the architecture for restructuring privately held debt claims. Before you hear about it in the next session, let me just step back and share some thoughts on how we view the current debt challenges and how these could be addressed. Now, as you mentioned, Adam, debt is not a new problem. In fact, 4 years ago in our fiscal monitor, we calculated that total non-financial debt amounted to about 152 trillion US dollars, or 225% of world GDP. Public debt had increased by 15 percentage points of GDP between 2000 and 2015. As the pandemic raged throughout the world, debt turned out to be a very serious pre-existing condition. All countries face the same crushing combination: higher spending to fight the disease and protect people, but lower revenue because of the recession triggered by all the necessary containment measures. Compared to pre-pandemic expectations, median debt in 2021 is projected to be up by about 17% of GDP in advanced economies, 12% in emerging economies, and 8% in low-income countries. This is an alarming rise. With fewer resources and less capacity, low-income countries are particularly vulnerable. About half of them are already in or at risk of debt distress prior to the crisis onslaught. So far, the world has managed to avoid a systemic debt crisis, mostly for two reasons. First, because of very low interest rates and massive monetary policy support. Central banks throughout the world quickly lowered interest rates and supplied liquidity. Swap lines were quickly established, and they helped many emerging countries maintain market access. Our latest estimation is that these measures add up to about 7.3 trillion US dollars. Second, extraordinary direct financial support, including IMF emergency financing to 76 countries and debt service relief to the most vulnerable economies through the G20 Debt Service Suspension Initiative, what we call DSSI, that went out to 44 countries, and the IMF's Catastrophe Containment and Relief Trust, which was made available to 29 members. This kind of support has bought the world some time, but we ought to use the time wisely. A pandemic-induced systemic debt crisis cannot be ruled out. The longer the problem is postponed, the worse it will become. The existing international architecture worked relatively well before the crisis, especially if compared to the quagmire of Latin America's debt renegotiations of the 1980s. These dragged on for years and led to a lost decade for the region. The inclusion of enhanced collective action clauses, or CACs, and other mechanisms in bonded debt have facilitated faster and more preemptive restructurings with higher creditor participation. Since 2014, over a dozen such restructurings have happened. Argentina and Ecuador are the most recent examples. But there are important gaps. A large stock of outstanding international sovereign bonds still don't have enhanced CACs. Non-bonded debt typically does not include such majority restructuring provisions. A growing share of debt is guaranteed by collateral, making it much more difficult to restructure. These characteristics are increasingly prevalent in low-income countries. Going beyond the report published today, the current architecture is not fully adequate to deal with official bilateral debt. Significant amounts are owed to creditors outside the Paris Club and don't follow its procedures or have any common restructuring framework. In the past, one debtor country negotiated with one creditor country within the Paris Club framework. Today, that same country has to speak with several agencies inside that country. Lack of debt transparency adds complication by creating information asymmetries and inter-creditor equity concerns. Countries will continue to need support. The DSSI, which was temporary by its design, needs to be extended, ideally for another 12 months. Otherwise, recipient countries will be forced to resume debt service at the expense of fighting the pandemic and its economic fallout. This would increase the human suffering and make recovery even harder. At the same time, countries with unsustainable debts should not delay restructuring and open negotiations with creditors before the situation worsens. Delaying only increases the costs, both economic and human. The DSSI extension should create incentives for recipient countries with unsustainable debt to tackle it promptly. For example, the extension duration could be linked to an IMF program designed to reduce these vulnerabilities, including by restructuring them if needed. My colleagues, Ceyla and Rhoda, who will be on following me, will go through the architecture and its technical aspects, but let me highlight a few priorities. First, to promote a wider adoption of enhanced collective action clauses in bonds and similar provisions in bonded debt. Second, to increase debt transparency to address inter-creditor equity concerns and information asymmetries. And third, official bilateral creditors, whether Paris Club members or not, should agree on a common restructuring framework. The IMF can contribute to these efforts in two main dimensions. First, at the country level, we will continue to support our members with financing, policy advice, and capacity development to strengthen debt management and transparency. We remain committed to providing debt service relief to our most vulnerable members. On a global level, we can support the DSSI extension while encouraging its beneficiaries to tackle debt problems promptly. We can facilitate debtor and creditor coordination and restructuring by providing debt sustainability analysis to determine the financing and/or relief necessary to restore sustainability. We can also condition our own financial support on higher creditor participation. And we will continue to support the G20 in their financing and debt relief efforts with co-financing, data, and analysis. Let me conclude. This is not the 1980s. We have better instruments and legal provisions. But that experience still haunts us, and rightly so. We know what happened: a decade of sluggish growth, a low competitiveness, and growing inequality. To avoid history being repeated, we need to address mounting debt vulnerabilities now. This requires better architecture and urgent collective action. All stakeholders must do their part. To paraphrase a saying often attributed to Abraham Lincoln, the world might be able to evade this responsibility today, but it cannot escape it tomorrow. Let's not wait. Thank you very much.
Thank you very much, First Deputy Managing Director Okamoto. I appreciate greatly, as I'm sure our audience does, you're putting this into the larger picture of the comparison to the 80s, the lost decade. As Managing Director Georgieva wrote just recently in The Guardian, we need to avoid a lost decade in human terms as well as in financial terms, but the financial aspect is critical to that pursuit. So let me now turn to our distinguished panel, which will go into more detail legally, operationally, economically, and practice of how to make that a reality, confronting this issue of insufficient collective action, insufficient restructuring potentially in private debt, in public sector debt held to private creditors. We will be led off by presentations from two of the department heads at the IMF who were the leaders of this report effort. First to speak will be Rhoda Weeks-Brown, General Counsel and Director of the IMF's Legal Department, who I've had the privilege to know and work with for a long time. She has had a distinguished career at the fund, mostly in the legal department, where she worked on a wide range of significant policy and country matters. But she also showed leadership as Deputy Director of the IMF's Communications Department, played a key role in the transformation of its strategy, and now is back as the General Counsel and Director and advises the IMF's Executive Board, management, staff, and country membership on all legal aspects of the IMF's operations. After presenting the paper, some additional remarks will be made by Ceyla Pazarbasioglu. Again, forgive me for the pronunciation. Ceyla is another distinguished public servant who has been in and out of the IMF, the World Bank, and the government of her native Turkey. She is now the Director of the Strategy, Policy, and Review Department of the IMF. Previously, she held several posts at the World Bank Group from 2015 to 2020, including lastly as Vice President for Equitable Growth, Finance, and Institutions. She worked at the fund in 2 extended periods, and in the early 2000s served the government of Turkey crisis management team to focus on reforming the pension system, which she did admirably, before being appointed as Vice President of the Banking Regulation and Supervision Agency of Turkey. After these two speakers, we will turn to our discussants, who I will introduce at that time. This is all on the record. There will be time for discussion between the commentary, but also people registered with PIIE can submit questions on the chat or on the Q&A function of Zoom, and we will get to those at the end of the presentations. Following all this, we will also have an update on the actual economic situation of emerging markets and the financial pressures on sovereign debt, moderated by Olivier Blanchard, featuring German Zettelmeyer of the IMF and discussed by Maury Obstfeld of the Peterson Institute. But first, let me turn to Rhoda Weeks-Brown. Thank you, Rhoda.
Thank you, Adam, for that very nice introduction and for hosting us here today at Peterson to launch this new IMF staff paper. Good morning, good afternoon, good evening to everyone in the global audience. Thanks so much for joining us here today. The IMF staff paper is prepared for the G20 IFA working group, as Geoffrey just mentioned. It takes stock of the experience with private sector sovereign debt restructuring since the IMF's last major stock taking in this area, which was back in 2014. Based on this experience, the paper identifies reform options to address gaps in the framework that could otherwise pose challenges for future sovereign debt restructurings. I will highlight broad takeaways from the paper and address reform options of a legal nature, and then I'll turn over to Ceyla, who will touch on other reform options and other aspects of the paper. Let me start, if I may, by turning. I was wondering if there's the presentation, but I don't think we need it. I'll just go ahead with the points. So I'll start by highlighting 3 points to put today's presentation in context. First, sovereign debt is the only debt class without a bankruptcy mechanism. As you are all aware, the international community has instead decided to rely on a contractual approach for sovereign debt resolution involving private claims. Second, as the paper picks up, as I mentioned, in 2014, where the last discussion left off, the focus is basically only on restructuring since that time. And third, this is an important exclusion from the paper. The paper focuses only on debt held by private sector creditors, and therefore doesn't cover official sector debt, which, as we all know, is also a very critical part of the sovereign debt restructuring puzzle. And as we all know, coordination between official and private sector creditors is quite critical. But again, that topic has been covered in other work streams. We may touch upon it today, but the paper itself doesn't get into those issues. So turning quickly now to the key takeaways from the staff paper. The first broad set of takeaways from the stock taking involve what I'm going to loosely characterize as good news. The recent experience suggests that the contractual approach for sovereign debt restructuring remains appropriate, and that it has been largely effective in resolving sovereign debt cases since 2014. As many of you will be aware, this framework relies heavily on collective action clauses, or CACs, which enable a qualified majority of creditors to bind a minority to a restructuring, thereby reducing the risk of potentially disruptive holder creditors. In 2014, the IMF and others in the international community endorsed the key features of so-called enhanced CACs, which include not only series by series voting to bind minority creditors, but also aggregated voting mechanisms, including the double limb aggregated voting and single limb aggregated voting. Again, I won't get into the weeds on those. I'm sure many in the audience are familiar with that, but just to remind you of these critical aspects of the framework. So, some specifics on this recent experience that I characterize so boldly as good news. The inclusion of enhanced CACs in bonds has been high, with about 91% of all new issuances since 2014, including these clauses. These clauses have been included in particular in New York and English law governed bonds, although we haven't seen take up in issuances under laws of other jurisdictions so far. Second, the recent data demonstrates that bonds with CACs in most cases trade at a premium to those without them, indicating their value to investors. This is particularly true for non-investment grade bonds, where CACs are presumably more valuable given the greater probability of sovereign debt default that may be perceived in those cases. Third, the restructuring of sovereign bonds since 2014 took 1 to 2 years on average, which is less than half of what those restructurings had taken in previous periods. Fourth, compared to earlier periods, a majority of restructurings have been preemptive. And again, as many as you will know, preemptive debt restructurings are always preferable. Defaults, if restructurings and defaults are associated with larger declines in GDP, investment, private sector credit, and capital inflows. We have a recent IMF paper, staff paper that discussed that in more detail. Fifth, compared to previous periods, average creditor participation in recent restructurings have been higher, aided by the use of CACs. We've also not seen post-restructuring creditor litigation when CACs were used. And while creditor coordination has indeed raised challenges in some cases, these appears to have been largely managed. Another thing I would put in another useful development that could be characterized in the good news bucket is the fact that enhanced CACs have now actually been used in an actual restructuring. So we have the recent deals involving Argentina and Ecuador. In both cases, the two-limb, double-limb voting mechanism was used. There were also other legal techniques that were used, in particular redesignation and the so-called Pac-Man strategy that raised concerns, I think it's fair to say, among creditors and some commentators. These two restructurings have now closed, with parties agreeing on language in the new instruments to address those specific concerns. Again, we have panelists here that were involved in those transactions and also have been closely following these, but I do mention that use of enhanced CACs as useful. And then another important development is that Euro area members have now agreed to incorporate single-limb CACs into all Euro area sovereign bonds starting in 2022. Again, an important development. One development that the paper notes also, and this is in the good news bucket also, is the fact that recent sovereign restructurings have incorporated state contingent features in new bonds. So again, for example, we have the hurricane clauses that were used in Grenada and Barbados. These clauses allow for automatic maturity extension and interest forbearance following severe shocks. And these kinds of features may be increasingly important given the growing climate risks and other environmental concerns. I would say watch this space also because IMF staff should be addressing the use of these kinds of instruments in a forthcoming staff discussion note. And then an interesting and more general point on the evolution of sovereign debt, the sovereign debt landscape, that a small number, that we also discuss in the paper, is that a small number of advanced economies, specifically the UK, France, and Belgium, have adopted targeted legislation, so-called anti-vulture fund statutes, to disincentivize holder creditors. These laws exist in essence as a complement to the contractual approach. They vary in scope and intent. They have not been used yet, and so there's little evidence about their effectiveness. The paper notes that in 2018, the European Parliament called on EU member states to adopt a regulation based on the Belgian law. And as we understand it, the European Commission is looking further into that issue. So again, just an observation that the paper also noted. Turning now to my second broad set of takeaways, and this is the part that it conveys what you would loosely characterize as more bad news. The headline here is that despite these very encouraging developments that I just summarized, the current framework has gaps that could pose challenges for future restructurings. So you may ask, what are some examples of these gaps? Well, first, there's a gap with respect to enhanced CACs themselves. While more than 95% of outstanding bonds have some kind of CACs, 50% of the outstanding stock of bonds still lack the enhanced variant that I mentioned we've all endorsed, and that have a more robust structure in terms of providing the ability to bind in minority creditors. Also, the single limb voting mechanism has not been used yet. The second gap is that some debt still remains very difficult to restructure. For example, non-bonded debt, instruments like syndicated bank loans, lack CACs-like majority restructuring provisions for their payment terms. Another important example of difficult to restructure debt is debt having collateral or collateral-like features, and we've certainly seen an increase in those kinds of instruments in recent periods. For DSSI eligible LICs, I'll mention, for example, non-bonded debt now accounts for about 39% of public and publicly guaranteed debt. So again, these less easy to restructure instruments do compose a significant portion of the debt stock for some countries. A third gap that the paper discusses relates to sub-sovereign debt, debt of provinces or states, and also SOE debt, both of which have increased in volume. This is an area of concern because debt vulnerabilities in the sub-sovereign and SOE sector can pose risks to the sovereign, as we all know, even if this debt is not explicitly guaranteed. There are also complications sometimes in trying to restructure these kinds of instruments, as they may lack CACs or majority restructuring provisions for payment terms. And in the case of state-owned enterprises, in many countries, they may not be subject to the generally applicable corporate insolvency regime. A fourth gap that we note is the diversity and complexity of claims against sovereigns, which has increased. A particularly significant aspect relates to arbitral awards, which in some cases can be significant and difficult to restructure. And then fifth, significant challenges arise from a lack of debt transparency, information asymmetries, and lack of, oh great, I see the presentation is on now. So significant challenges from lack of debt transparency, information asymmetries, and lack of clarity on the parameter of claims, what is official, what is commercial. These gaps can hamper the rapid resolution of debt distress and undermine risk assessments by creditors and other stakeholders. And high economic uncertainty of the kind we're seeing now, needless to say, compounds all of these issues. So on slide 7, I will cover a few of the key reforms. So we've looked at the good news and the bad news. So this is the therefore part, therefore what? The paper discusses a range of possible reform options that could be explored to address these gaps that I've just summarized. I should make clear that these are not reform options linked to the IMF per se. Again, we're asked to do this work, but I think it's fair to say that most of these options will require a unified effort, not only from countries and from creditors, both official and private, but from others in the international community as well. So to go through these, a few of the legal reforms, and then Ceyla will pick up on remaining ones. But there's a set of reforms to basically strengthen the contractual framework itself, the contractual framework for bonds, and to further limit holder-creditor behavior. The IMF, of course, will continue to encourage the inclusion of enhanced CACs in international sovereign bonds. But the paper also makes the case for encouraging the use of enhanced CACs in international bonds of sub-sovereign entities, like in provinces and states, as I mentioned earlier. And also the paper further notes that sovereigns should be encouraged to use bonds with trust structures. Again, without getting into the legal weeds, this is a legal device that provides additional protection against disruptive holder-creditor enforcement actions. Third, a set of reforms is related to loans. As I mentioned earlier, these generally do not have the sort of tax-like majority restructuring provisions. And so the thought here is, as was done in connection with enhanced CACs, the official and private sectors could perhaps join forces to look more deeply into this issue and consider developing majority restructuring provisions for payment terms in loans, and also encourage their widespread adoption. A fourth reform option is that the official and private sectors could join forces also and cooperate more fully on issues related to collateral. This could include promoting greater transparency about the use of collateral. It could include strengthening debt authorization and management capacity, something that the fund is already focused on. Negative pledge clauses could also be strengthened and more rigorously enforced to disincentivize the excessive proliferation of collateralized debt. And then I would mention quickly that while not in any means put forth as a reform option, the paper also raises a question about the potential desirability of the use of these anti-vulture fund laws that I mentioned that do exist in a few countries. The paper notes that there currently appears to be very little interest in the official sector for such a move. And in any case, that any efforts in this area would need to be designed to limit the impact on creditors' rights. It would need to avoid undermining the secondary market. And that in particular, further analytical work, market consultations, and so on would be needed. But again, this is as part of the stock taking that these observations have been made. I will stop here again, just by emphasizing that these reform options will require collective effort and but have been put forth to basically start that conversation. I'll turn over now to Ceyla, who will cover other reform options, not of a legal nature, and other aspects of the paper. Thanks again for your attention. Ceyla, over to you.
Thank you, Rhoda, and good morning, good afternoon, everybody. My name is Ceyla Pazarbasioglu, and I'm the Director of Strategy and Policy Review Department at the IMF. I'm very pleased that we are discussing this very important issue today, and I would like to thank Adam and the Peterson Institute for this. So together with Rhoda and our Managing Director, Kristalina, we published a blog today, actually, calling for a reform of the international debt architecture. Rhoda talked about the progress as well as the challenges and the reform options to improve the contractual framework. And I'm going to talk about two issues. One, reform options in terms of official sector policies. And second, very importantly, responses to a potential systemic debt crisis. So let me start with reform options in terms of official sector policies. First, consideration could be given to increased use of state contingent instruments, particularly to protect debtors against downside risks. Rhoda already mentioned the examples of hurricane clauses, but state contingent debt can be used much broader. This is particularly relevant now during the pandemic and the extreme uncertainty both in terms of health and economic developments. Such instruments, in theory, can help avoid protracted negotiations between creditors and debtors over recovery values and potentially even relapse into default post-restructuring. But these instruments provide upside to creditors, such as GDP-linked warrants, but they have been rarely used in practice. These are equity-like instruments and have been heavily discounted given their non-standard designs as well as illiquidity and idiosyncratic risk profiles. We are finalizing an IMF note on how to improve the design of such instruments. This should be available over the coming weeks, and I think it does really add to the debate and potential use of these instruments. Second, IFIs can play a role in terms of their lending policies to support orderly and speedy debt restructuring. IMF policies will be reviewed in 2021 to ensure that they are as effective as possible. These include, for example, the IMF's arrears policies, IMF debt limit policies, and the IMF MAC DSA, which Jeremy will talk about shortly, and can lead to changes that can improve the current system. Just to give you a brief overview, the debt limits policy will provide countries with more flexibility to manage their debt while placing safeguards to preserve or restore debt sustainability. One key element will be the enhanced data disclosure requirement to the IMF, and that's very important in terms of encouraging greater debt transparency. We have the review of the IMF's lending into arrears policies. This will encompass a review of the perimeter of official and private claims. It will also review the IMF's role in pre-default restructurings to maximize incentives for constructive creditor-debtor engagement. It will further review whether the IMF's role in furthering creditor engagement, the famous debtors' good faith efforts in post-default cases, has been appropriate or could be enhanced. So these are very important IMF policies that will be reviewed during 2021. There is also a need for that transparency, and of course I mentioned our review of policies, but also our efforts in terms of working with the G20, working with others, in terms of really pursuing initiatives that enhance that transparency. Of course, the main responsibility lays with the sovereign and its creditor. The IMF and the World Bank has been working jointly on this as part of the multi-pronged agenda on debt. We also support that transparency through IMF policies like the leaked DSF, IMF's debt limits policy, our surveillance work, Article 8, and so on. And of course, capacity development to strengthen members' debt data reporting and assisting other stakeholders' transparency initiatives. So this is also a key area of work. We also, of course, put a lot of effort into continuing capacity development on debt management and debt data reporting. Both the bank and the fund have been very active in this space for many years, and we will continue providing the much needed capacity development. Let me turn to now to discuss a possible response to systemic crisis. What if the current architecture is insufficient? As Rhoda mentioned, there has been progress, but there are gaps, as we have seen in recent restructurings, as well as a lot of the work we have been doing. And it is very important that, given the surging public debt levels that have been triggered by the pandemic, we already started this crisis with record high level of debt, and this has become much worse given the pandemic. We talk about possible responses if we were to have a widespread sovereign debt crisis due to the pandemic. And in this case, of course, a large number of sovereign debt restructurings, if they were to proceed in parallel, that could lead to creditors with claims on many countries facing aggregate losses, which in turn could make them less cooperative in resolving the situation. The restructurings could become more protracted and difficult, creating difficulties for both debtors as well as the system. Of course, we're not calling for such a crisis. It's too early to tell. But if it were to rise, the contract-based reform options discussed in the paper would not be applicable, as these reforms will take time to be implemented and to affect the outstanding stock. So in that case, additional financial carrots or statutory sticks might be needed to be considered, of course, on a very carefully circumscribed basis. So in terms of carrots, what are these? These are IFI financing of cash or credit enhancements in difficult restructurings when the required debt relief is very deep. Such enhancements could make debt deals more feasible. At the same time, we note that this approach is subject to significant limitations. Of course, the most obvious one is that IFIs have limited financial resources with competing demands, and such demands will be further intensified if we were to have a systemic crisis. So IFI financing of financial incentives could contribute to resolve a systemic debt crisis, but it's not necessarily an instrument that could be used on a very large scale if we were to have a major systemic crisis. What are, and in terms of sticks, there are, in principles, this could include targeted domestic and international law statutory tools that limit or delay in a time-bound manner creditor recovery enforcement actions or the timing of lawsuits, which in turn could both reduce incentives to hold out and limit the ability of holdouts to disrupt a restructuring. In the paper, we discuss these issues and emphasize that these statutory options carry potential legal and policy drawbacks and should be used only as a last resort and on a time-bound basis if needed to address the unique challenges posed by a systemic crisis. But these are, of course, options. In terms of, I mentioned the IFI financial instruments, that's in the next slide. I think, Jeremy, if you could, so I already mentioned some of this and the pros and cons of using these instruments. And in particular, we have precedents. The Brady deals helped resolve the last systemic debt crisis. But again, if you look at the changing landscape in terms of debt with non-Paris Club creditors, with much more complex instruments and so on, it's not clear how well these IFI finance sweeteners could be used, and they have limitations. This can impact the preferred creditor status of IFIs, which is really critical at this time of the crisis for them to be able to lend and in concessional terms to member countries which really need them. And so if I can conclude, Jeremy, if we could go to the next final slide, please. So just to conclude, lots of progress in terms of adoption of enhanced CACs. 50% of international debt stock have these features. Issues of some issuance of state contingent debt, potential use of more. Restructures are much more preemptive, which means that much less losses, output losses, and much quicker recovery for countries, higher participation. So significant progress has been made, but we also face new challenges, much more fragmented creditor base, non-bonded debt, collateralized loans, increased share of sub-sovereign public debt. So we have been also challenged. The whole international debt architecture has been challenged recently, and these will require reform. And some of this we discussed in terms of improving the bond contracts, majority provisions, debt transparency, better debt management, review of IMF lending policies, which will all contribute. But if we were to have a systemic crisis, we will need more tools, because this architecture will not be sufficient to deal with major consequences. Again, as I mentioned, this is not our baseline, but we all have to be prepared and contingent planning in place. And therefore, I think we need to discuss these different options, pros and cons of different options, and so that we are ready to use them potentially as a last resort. Thank you very much, and over to you, Adam. Thanks again.
Thank you, Ceyla and Rhoda, for a terrific presentation. I should say to all our audience, which probably goes without saying, the new paper by Rhoda, Ceyla, and their colleagues is available. We have the link on the PIIE event website. It is, of course, also posted on the IMF website. Also available is on the IMF website is the blog that Rhoda and Ceyla mentioned that was co-authored with Kristalina Gorgieva. We have a great set of discussants, all of whom are in the actual practice as well as the policy analysis of dealing with sovereign debt and private creditors. I'm going to introduce all three of them at once so that we can have a freer flow of their comments. These are people we value their opinion, and they're obviously speaking in their own capacities, though of course they have well-established points of view. Speaking first is Peter Orszag. The Honorable Dr. Orszag served as 37th Director of the Office of Management and Budget under President Barack Obama, and also previously as Director of the Congressional Budget Office. But he has had a distinguished career in, I shouldn't say but, and he has had a distinguished career in international finance as well. Previously, till June 2019, as the firm's head, as Lazard's head of North American M&A and global co-head of healthcare, and he is now, since a year ago, the CEO of financial advisory at Lazard, which of course has played a critical role advising the governments of Argentina and I believe Ecuador in the recent debt restructurings. Before serving the Obama administration, after serving the Obama administration, Peter served as Vice Chairman of Corporate Investment Banking and Chairman of Financial Strategy and Solutions at Citigroup. I am also delighted to say that Peter is a member of the board of directors of the Peterson Institute, which is good for us. Second to speak is my dear colleague and friend, Anna Gelpern. Anna is not only a non-resident senior fellow at Peterson, she is, of course, the professor of law and Agnes N. Williams research professor at Georgetown University. Anna is a font of new ideas, was one of the leaders of getting CACs widely adopted in the first place, which is part of the good news that Ceyla and Rhoda referred to, although she would, I certainly agree with Ceyla's conclusion that that does not solve the architecture problem on its own. She has previously held faculty appointments at American University Washington College of Law, Rutgers School of Law, Newark, Rutgers University Division of Global Affairs, and been a visiting professor at Harvard Law School and University of Penn School of Law. She has previously served in legal and policy positions in the U.S. Treasury Department and has, in her copious free time, also founded a movement of law and economics on a macro side, which a number of us have been very stimulated by. Third speaker in our panel is another person working right at the forefront of legal and practical matters resolving international debt issues, Deborah Zandstrom, one of the leading lawyers in the world on international finance. She joined Clifford Chance in 1992 and has been a partner there since 2009. She's worked in the firm's capital markets, banking, and derivatives groups in London, New York, and lucky her in Madrid, and has been seconded to Citibank in London and Barclays Capital in their legal departments. She's currently a member of the firm's finance group with special focus on sovereign-related work, structured products, and derivatives. So in that order, no more than 10 minutes each, asking Peter, Anna, and Deborah to give their views, and then we'll have Rhoda and Ceyla respond. And a huge amount of substance to get through, a huge amount of lawyer and technical financial to get through. I'm confident we can do it. Peter, over to you.
Thank you so much. Thank you, Adam, and to my friends and colleagues from the IMF for presenting this new paper today. Going to make 5 points. The first one is that discussions like this really matter. As the paper points out, it was important that the IMF endorsed a set of enhanced features for collective action clauses in 2014. Thereafter, pickup was significant. So just to level set, these discussions have crucial effects on sovereign debt markets across the globe because of the IMF's honest broker role. And that brings me, though, to my second point, which is that credibility and that honest broker role is hard to achieve, but it can also easily be torn down. And I do think, just to my friends at the IMF, that there's a threat when the IMF builds up too large of a creditor position in any country, such as happened in Argentina, because that puts at risk or creates tension between the policy role and the preferred creditor status that can endanger the honest broker function. And I think we saw some leading edge of that in some of the negotiations, and it would be obviously better to avoid having that happen in the future. The question becomes, what do you do when presented with a country that needs that additional financing? And I think there are alternatives that we should be exploring that involve co-financing with other entities that go beyond just the IMF. The other point I would make on this front before moving on is that when the IMF is in the position of having a very extensive creditor position, there's a lot of attention paid to the cost of the exceptional access lending programs, which are often seen as a bit excessive relative to other creditors. And so the question becomes, I understand the purpose is to discourage borrowers from tapping those exceptional access lending programs, and also the money is used for other purposes that the fund receives, which would need to be dealt with. But I think it exacerbates this point about the honest broker role to have a interest rate that is at least seen as being excessive relative to the fund's senior preferred creditor position. Third point is that especially given the evolution of the creditor base that the paper documents, and that I think is clear to everyone who's working in the field, it's crucial, and this is really the heart of the paper in my opinion, that we continue to build on the progress that has been made under the IMF's leadership to continue to reform and strengthen the provisions and the things that have led to the successful resolution recently of sovereign debt crises. And I think there are three that already have been mentioned, but that are worth emphasizing again for further work and future progress. The first is on the CACs, the collective action clauses, which I think within that we should focus on the single limb mechanism as which has not been tapped, to explore whether we need to reduce the threshold for using the single limb mechanism. And secondly, whether there should be some thought given to the so-called uniformly applicable condition that applies when that approach is deployed that requires certain constraints on the menu of options that are presented under that aggregation method, and I think might impede use of that mechanism. There are other ways of ensuring equity for creditors that might not be exactly what is currently allowed. It was interesting, by the way, in the paper, you might think that making the CACs stronger, as it were, would increase the cost of capital. But as the paper notes, there's at least some evidence that it might cut in the other direction, that bonds with enhanced CACs traded at a premium and with lower yields than other bonds. I think that's actually a quite interesting empirical finding that if confirmed by other evidence, suggests that this is not only beneficial for the borrower, but also beneficial for the market as a whole, including the creditors. Second dimension of future activity, I think, and again, it's been mentioned, but is standardization in particular of value recovery instruments. It is very difficult to negotiate bespoke such instruments in each new setting. And I think some standardization in terms of what are you indexing off? Is it GDP? Is it exports? Is it the level? Is it the growth rate? And so on and so forth might make these instruments more appealing to creditors, because today, just in the negotiation process, you get very little credit for offering up these sorts of instruments, given the uncertainty and the bespoke nature that surrounds them. And then the third vector for future work is contingent adjustments. And in particular, I would be focused on whether there is some form of standstill that could be automatically triggered, perhaps by the IMF itself, by the way, issuing some sort of, we're in a pandemic or unusual situation, in debt contracts to create a standstill of payments while you're in the midst of a crisis. Obviously, there would be a lot of work that would need to be done with the rating agencies and creditors to ensure that standardized conditional short-term relief of that form did not automatically trigger ratings downgrades. And I think that's a significant contributor to why the DSSI has not had pickup. So we need to think about that as we build out contingent adjustments for the future. Fourth topic, which is admittedly outside of the IMF's purview, but it affects the dynamics involving debt renegotiations, involves some key local jurisdictions that have rules that impinge on the sovereign debt market. I would particularly highlight the New York State law, the New York State civil practice law, and rules that have set prejudgment interest rates for civil litigation, including sovereign debt litigation, at 9%. That's because those rates were set in 1981 when inflation was much higher. The nominal rate has not been adjusted since then. And what that means is that if there is sovereign debt litigation and the sovereign loses, the sovereign is paying a real interest rate that is exceptionally and frankly unnecessarily high. That prejudgment interest rate should be tied to current market interest rates and avoid basically a windfall gain and an incentive to litigate for creditors. And then finally, I know the next panel is going to deal with this, but just on sovereign debt itself for a second, two quick subpoints. One is we need more sovereign debt right now, not less. I think the biggest threat to the global economy right now is a significant withdrawal of the fiscal impulse that was put in place in the immediate aftermath of the pandemic. We're seeing that play out here in the United States, where the fiscal impulse is shifting rapidly from a big net positive to a net tailwind. Even though Congress is currently, as we speak, debating whether there will be another round. And then the second point is that I always get a little nervous when the conventional wisdom becomes 100% sure of itself. And I'd say that's where we are with regard to low rates, continuing as far as the eye can see and forever. It's interesting to me that the last session that the Peterson Institute held was about a new book, The Great Demographic Reversal, suggesting that the era of low rates has been driven by secular demographic trends, especially in China, that those trends are reversing themselves. And so this assumption of low real rates, as far as the eye can see, may not hold in the future. And I'd at least urge a little bit of caution about our confidence that we're in a low rate environment permanently. So especially if countries do the right thing and continue to support their economies throughout the pandemic and borrow more now, and even more so if rates rise in the future along the lines that Charles Goodhart and his co-author in The Great Demographic Reversal suggests, we may well wind up with a lot of sovereign debt pressure and difficulty in the future, which just leads me to the conclusion that an all of the above approach to the ideas that are discussed in the paper and some of the ones that I mentioned should be pursued, and we should be doing that with a sense of urgency. Thank you.
Thank you, Peter. I should just note, I'm glad that Peter mentioned our recent event, but those are not necessarily the views of Peterson, just as Peter's views are his own. But it's wonderful to have this kind of clarity and direction about what needs to be discussed at the policy level. Continuing in a similar spirit, let me turn to Anna Gelpern, please.
So, Adam, thank you. And it's wonderful to be with many old friends, and hello to everyone on TV. Thank you again to the fund for producing this paper. And I think it's really important for us to recognize the IMF staff's contribution in this space for many years. The fund has been an intellectual anchor for thinking about sovereign debt for decades now. And the one thing I really hope we take from this is that you need to continue and more work, sorry. I wanna talk a bit about, I guess the title is where I wanna start, because I think there's always been this tension between architecture and interior decoration. And it's awfully hard to tell where we are sometimes. And that's a nod to Jeremy, with whom we wrote a paper called Cacks and Doorknobs. And I sometimes wonder whether we're talking about doorknobs or walls and ceiling. So with that, the architecture of sovereign debt management looks more and more like it was made for a world that doesn't exist anymore. It's premised on a lot of bright lines that may be administratively necessary, but just aren't tenable. And I'm going to rattle off a few of them, but I think you will get the idea very quickly. The line between official and commercial debt is unbelievably blurry, always has been. Official and commercial creditors, ditto. Everyone is a hybrid. We're going to see more hybrids. And so having institutional features hang on these distinctions, I think, buys us a lot of trouble. Domestic and external, bonds and loans. Part of what I take from this paper is that loans these days look a lot like bonds. And so they need some of the same contractual matter that bonds have. But then this is really not a this clause or that clause conversation. This is more a bonds and loans, funds and banks are looking awfully similar now. So what do we do about that? Low income and middle income countries. Our infrastructure for financing low income countries assumes small amounts over a long period of time to build, to develop, right? Not so much giant flows in and out, but as more countries access financial markets, and as we get some of these exogenous shocks like pandemics and climate events, some very low income country problems look kind of like old middle income country problems. And I'm not sure that we necessarily have the capacity to address that. And other more amusing distinctions like voluntary and involuntary debt restructuring and bilateral and multilateral creditors are a lot blurrier than they sometimes seem. So with that in mind, I want to try to kind of move away a little bit and think about three big picture ideas, namely equity, transparency, and uncertainty. And I will be very quick about relating this to the IMF paper. So on the equity front, CACs are often misunderstood as a debtor-creditor device. They're an intercreditor equity device. And intercreditor equity, to my mind, is the problem of the day, given fragmentation and the diversity of the creditor base. And kind of playing whack-a-mole with sticking CACs in different discrete instruments, to me, is probably not the way to address the broader intercreditor equity challenge. Again, love CACs, love vitamin C, love aspirin, but I think we need to think more systemically, particularly as we reassess architecture. The challenge is this fluid movement from one instrument to another, and arbitraging the boundaries. And I think that I'm not sure that CACs solve this. By the way, the statutory mechanisms that the paper talks about are also very much an intercreditor proposition. And of the ones that have been out there, the ones in the UK that are much more directly tied to equity between official and private creditors in the HIPC context strikes me as more sensible than some of the others. Second, transparency. Public debt is public. I'm very tiresome about that. It is scandalous, unconscionable, insane that public debt is one of the least transparent asset classes in the universe. It's wrong. The constituents here are people, citizens of the borrowing countries, as well as the pensioners that ultimately invest in this debt. So we've got to figure out a public, accessible, intelligible way to disclose the real state of government debt, including debt terms and debt restructuring precedent. And I do want to flag that this is not just a China bashing proposition. This problem way precedes the growth in Chinese lending recently, the advent of other new creditors, the disclosure system, the information presentation system has been fragmented, parochial. Just folks, let's get it done. The platform should be a public one. We cannot rely on enterprising researchers at wonderful universities around the world, or for that matter, private trade associations. This is a public matter, it's a public good. And by the way, just to get a little controversial, hidden debt shouldn't be enforceable. How we get from here to there, we can talk in the Q&A. My final point is this point of uncertainty, which I think is raised in both the fund paper, and Peter just talked about this. So I do think that this experience really highlights the need for mechanisms, architectural mechanisms, as well as doorknobs to deal with uncertainty. And I do think that contingent instruments are one of the few areas that actually would be worthy of co-financing and a public subsidy. I mean, my own view of this is that Brady's are mentioned one too many times these days. It's worth spending public money on one of two things: deep debt relief or addressing these structural gaps in the international financial system. And I think this is one of those contingent instruments, or one of those structural gaps. The official sector should be using contingent instruments in its own lending and in co-financing, and it should start now. We wouldn't be talking about the SSI extension if official debt had automatic extension triggers. And this is an opportunity to experiment with precisely the triggers that work, and take some risks that market participants may not be willing to take. One last point, I think this is sort of channeling the recent work by Mervyn King and colleagues. Hurricane clauses don't work in a pandemic. We should think about more broadly about more generic and more kind of adaptable ways of dealing with these kinds of developments. So I want to close on the thought of architecture again, and the role of the IMF, the World Bank, the Paris Club, or any other club that might emerge. I think the most important thing right now is for all the stakeholders to agree that we're building one building as opposed to, you know, a tent city or a strip mall. So, you know, we need to really integrate the thinking across the institutional landscape and make sure that everyone is at the table and new creditors and old ones are invested in the architecture project. So thank you so much.
Thank you, Anna. Great to have your views and your incitement to more work and more reform. Let me now turn to Deborah Zanstra. Deborah, please.
Hello to everyone, and thank you, Adam, for the opportunity to make some observations today. I thought the paper and the way it covered its highlighted topics was really excellent, particularly considering the team were working remotely, and it really speaks as to your close collaboration as a team. Many of the issues described are quite technical ones, and the paper strikes, I think, the right balance between delving into them in a meaningful way, but also setting out a set of relatable policy issues. Unlike your 2013 paper on the then developments in sovereign debt restructurings and implications for the fund's legal and policy framework, I feel the stock taking in this paper is broader and less focused on holdout creditors as the primary concern, which I think is good. But it does mean that some of the areas of focus would constitute incremental improvements to the existing sovereign debt restructuring architecture. And in respect of some aspects, there may be less consensus or impetus by relevant stakeholders on the way forward. And hence, I think a process of engagement and consultation will most likely be needed on a number of the suggested fronts, with potential reforms being ranked in terms of priorities. That said, the circumstances we're all living through at the moment should instill a sense of urgency and significance to this work, and will hopefully create an environment in which reforms can be developed at a good pace. Taking some of the points in the paper in turn, the need for greater transparency is irrefutable as it relates to debtors, but also official bilateral creditors, multilaterals, ECAs, and private creditors. On the private sector side, good progress has been made through the IIF voluntary principles for debt transparency, but reaching a landing on the potential repository and getting that party up and running is something which should come about as quickly as possible. Good progress is being made with the OECD, but the issue of funding still remains to be resolved. On the enhanced contractual approach, I would make the following points. A switch to trust structures in respect of English law governed bonds is unlikely to happen, I think, without a nudge from the fund to sovereigns that this is preferable, and it could take some time. On loans, you've highlighted the fact that changes to payment and other significant terms require unanimous consent, although of course most loans have inbuilt majority lender provisions for changes to other terms. Including changes to payment terms in the majority lender provisions should be fairly easy to achieve from a legal documentation perspective, but it will require a wholesale shift in market approach. So thought will need to be given to engagement with bank lenders and to maybe bringing into the debate the LSTA, LMA and APLMA to see if a joint approach by these loan market industry bodies, such as with their recent collaboration on the green loan principles and sustainability linked loan principles, could be replicated. There are other provisions that could be revisited in loans, including pari passu, which has not always caught up with the bond standard. Inclusion of yank the bank and if you lose, you snooze provisions could also make a difference, in particular where waivers are requested by sovereigns and lenders or third-party investors behind them are slow to respond. The need for waiver requests and their role has become important in the context of DSSI. These loan contractual terms are typically considered on a deal-by-deal basis, but some technical guidance highlighting the issues could, however, I think, be put together and be helpful. But it will take a party with some convening power to take this forward. I agree with your proposals on negative pledge clauses as they relate to authorizations and transparency, although it would be good to know what you understand excessive creation of secured debt to be. When it comes to tightening negative pledges, that is a difficult thing to standardize. Part of the challenge is that for every debtor, you already have a proliferation of different negative pledges, such as those of the World Bank and other MDBs, those in bonds, which may be narrower, and those in loans, which may be more extensive, but also more tailored to the specific country. Ensuring that the negative pledge does not prevent a country from raising good debt that can support economically enhancing projects is also important, and hence standardizing is difficult. Transparency, though, should help in this context also. Most lenders and investors are aware of negative pledges in a sovereign bond, where the prospectus is public or if the public World Bank is a lender. But negative pledges in loans or benefiting bilateral official lenders or other MTBs tend not to be public, in which case it's difficult for lenders to be aware of workarounds or themselves corroborate potential breaches. This is a complex area with a number of intercreditor equity sensitivities, not just across private and official sector, but also among official sector stakeholders. On state contingent features, I agree that their use to give a breather following the occurrence of a natural disaster would be a good thing. As you say, MDBs and official bilateral lenders should also take this up and in fact lead the way. The Paris Club has also been supportive in the past. The ICMA sovereign, hurricane bonds and loan term sheets were developed, which are a good starting point, but were designed for countries in the Caribbean, where the underlying event triggers a payout under the Caribbean Catastrophe Risk Insurance Facility, and this work should be expanded to other regions and beyond the CRIF. The pandemic has opened the opportunity, I think, for a positive reception by the market to instruments with inbuilt interest deferral mechanisms, if carefully structured, so this work could gain some momentum. Similarly, sovereign debt linked to ESG and sustainability should become mainstream for sovereign and OSOE issuers as a way of also future-proofing their economies to future exogenous events and decreasing the need for sovereign debt restructurings. Sovereigns have been slow to participate in this segment of the market, and additional support from IFIs by way of credit enhancement and technical assistance on sourcing the underlying projects is much needed. For countries with funding needs in this space, but limited capacity to incur new debt, transactions like the Seychelles debt for nature swap could also play a role, but take up following that deal has been slow. You touch on targeted legislative options. The UK's Debt Relief Developing Countries Act followed consultation with the market and was initially put on the statute book on a temporary basis, pending a further review as to unforeseen market consequences. Only after there were none was it made permanently in 2010. The Act was drafted, as Anna has mentioned, so it's very precise in scope and limits claims in the English courts against countries which benefited from the then HIPC initiative only. The existing French and Belgian legislation is much broader in scope. Any attempt to mirror their approach would, in my mind, for sure have secondary market implications, so any work in this area will need careful thought. As most external indebtedness raised is governed by either New York or English law, these are the two systems of law under which any legislative action would have most impact. Whilst the UK set a good precedent with its HIPC legislation in this space, in view of COVID-19 and Brexit, the consideration of legislation in England on this at this time would seem unlikely to me. I'm not sure about the New York position. It may be different, but others will be better placed to comment. The UN has stepped in previously, but in very specific country cases, and I think there would be foreseeable market consequences if any broader initiative was taken to immunize the assets of multiple countries as a group, and that doing so as a preemptive measure against the potential challenges of doing multiple COVID-triggered sovereign debt restructurings at a time should be avoided. Recent events have shown, at least on the private sector side, that creditors can organize quickly and are willing and able to use time and resources to address emerging sovereign debt crises. While participation in DSSI by the private sector has been slow, this is largely due to concerns among both debtors and creditors around ratings downgrades and loss of market access. And should any DSSI countries in due course need reprofiling or debt relief, I have no doubt market participants would mobilize quickly. I welcome your thinking on the impact that the lending policies of IFIs can have in supporting sovereign debt restructurings, and whether, like EFSF in the case of Greece, they could provide some credit support in the context of sovereign debt restructurings. I hope that your review of your lending into arrears policy, long overdue now, can continue, together with analysis on pre-default scenarios. Any commentary on the formation of creditor committees, I think, will require careful development. At this stage, I would only say that if bondholders end up organizing themselves in more than one committee, the system should not dampen this from happening. If bondholders feel strongly enough to seek separate representation, just as others will want to discuss matters bilaterally with the debtor, that should be seen as a welcome engagement with the situation and a desire to seek a solution. Related to this, the recent Argentina experience raised a number of important areas of concern. Creditors had to engage with Argentina and its debt sustainability parameters without information as to the government's economic and fiscal policies, short or medium term. And yet the IMF staff technical note on Argentina's public debt sustainability played a big part in Argentina's arguments as to its position with bondholders, without the latter having the benefit of the oversight and policy implementation requirements that the fund would originally engage in. This raised questions and concerns for investors in the context of Argentina and beyond, and it would be good if the fund could give this some thought going forwards. Argentina also raised a number of questions which you touch on in your paper as to how the CAC technology can be harnessed in a real country case, and had a number of features: the potential multiple use of redesignation, the Pac-Man feature, the formulation of the minimum participation condition, and lesser economic benefits of those CAC'd in, which have left market participants concerned. I welcome a period of introspection on this with yourselves, with ICMA and others. To conclude, congratulations on a very comprehensive paper, which will form the basis of many debates and ongoing discussion in the months to come. And I very much look forward to a continuing dialogue.
Thank you very much, Deborah. This is great. I think we have a few questions in the queue, but I think it is very important, given the substance of our three discussants, to give Ceyla and Rhoda a chance to respond. Rhoda, would you like to pick up anything? Then we'll go to Ceyla.
Sure, thank you, Adam, and thanks to Peter, Anna, and Deborah. Again, those were very thoughtful contributions. I think we share most of what you all said, and I don't see a huge amount of difference. I try to keep track of everything that was said, so I'll try to cover what I remember. Hopefully I didn't miss anything, and of course you can come back and Ceyla will pick up other parts.
You don't need to be completely comprehensive. Right?
Indeed, it would be another hour if I tried to do that.
Like 5 minutes. So
yeah, okay. So let me just be quick then. I think one overarching theme that came up in or something all three of you said, but it's this idea of the need for further engagement and consultation and discussion. And again, I couldn't agree more. This paper was meant to be a start in the conversation, and that's why we use terms like reform options. We don't even call them proposals, because clearly that would need a lot more discussion. So again, I just want to confirm and to absolutely agree that this is meant to begin to be the beginning of that conversation. On issues regarding on the issue of debt transparency and so on, again, clearly a huge issue that we're quite focused on. I think at least with respect to the work the IMF is doing, you will see we're part of the ongoing policy reviews we'll be having soon, including on the debt limits policy. We think we'll add at least further improvements in the IMF's own contribution in that area. Of course, the broader issue of the repository for debt data that I think Anna and others referred to, again, that discussion has been underway. We fully support the IIF in that effort. And hopefully some of these issues that Deborah mentioned with the OECD and others will be resolved to enable that to happen. On the issues of, Peter mentioned the IMF's creditor position and so on. I think that what we've emphasized and looking at the way this crisis is now, will certainly be emphasizing even more is the critical catalytic role that the IMF plays. People forget that fundamentally that is the whole point of IMF financing. We come in when others won't, in many cases. We help countries to design the sort of policies that we think they need to overcome their BOP difficulties. And that, if we're doing it right, should encourage others to come in. And I think that's a part of our role we'll certainly be emphasizing going forward. A lot of the needs that will likely arise in some of the cases ahead of us would not be of a nature that we could sort of finance solely. And again, I think that the issues around the catalytic role of the IMF are fundamental and will be stressed. On the broad issues related to standstills and statutory options, et cetera, I would first just say quickly that we felt that we needed to discuss these options in the paper when you're asked to discuss the architecture. And if you say nothing about these sort of options, which have been widely discussed out there, it would have been almost a gap on our side. So we did put this in again as a start of the conversation. On the points that both Anna and Deborah made about the sort of more narrow and therefore useful, perhaps, focus of the UK law, I think we're sympathetic to that. In fact, we mentioned in the paper that some options have suggested that if those kinds of options were ever considered, linking with IMF or official sector support would be the way to go, similar to the HIPC link in the UK legislation. And that would be good. Peter's interesting idea about having contractual provisions with contingencies linked to IMF actions of various kinds, I think is quite interesting. It's I think like most of the contractual options we've discussed, there's going to be the stock problem in terms of how you get it incorporated into the instrument we need to deal with now. But certainly going forward, that's something that could be considered. It's a much narrower aspect of the contingency, and maybe it's so exogenous that it will overcome some of the difficulties that have arisen in some of these discussions of states' contingent instruments. Let me just see if I had anything else that I thought. Yes, on the issue of finding balance with respect to collateral and secured debt. Again, couldn't agree more. We have a box in the paper that sort of spent a lot of time discussing the circumstances under which collateral and security can be quite beneficial from an economic standpoint. I think the key point here really is to increase awareness and discussion around these issues. Oftentimes, both debtors and even some of the creditors with some of these like negative pledge clauses, for example, don't seem to be fully aware either of the scope or of what's happening. So I really think a discussion and more transparency goes a long way, but certainly the intent isn't to in any way limit those kinds of options.
Thank you,
I think
Rhoda.
I'll stop there and switch.
Yeah. Ceyla, would you like to add anything?
Just very briefly, Adam, I wanted to mention three things. One, in terms of what Peter and Anna both mentioned, in terms of the VRIs, the need for potential standardization, because this would of course, lead to a more liquid secondary market, and this would have strong advantages in terms of relatively simple payment structures and hopefully encourage investors to develop greater familiarity with their pricing. For example, linked to commodity prices are easy for investors to price, but of course this may be less clearly linked to sovereign debt sustainability. So these are all issues that we have been discussing, and we have a paper that's going to be coming out staff discussion note in mid-October, which looks at these issues in more detail and thinking about ways to standardize these instruments, because I agree that they could play a very important role. The second issue, which is very dear to my heart, is what Anna said: public debt is public. I keep saying there's good debt, there's bad debt, and there's ugly debt. And I think we really need to work on making sure that debt is growth enhancing. Many countries need debt, so debt is not a bad thing. It's just that it's not transparent sometimes without knowing that what countries already owe and on what terms. It's very difficult for creditors to make informed lending decisions. And it's very also difficult for them to contribute or participate in restructurings rather when they don't know the terms given to other creditors. So I think there is a clear need for more transparency, and there's a lot of work on this that both IMF and the bank and others, OECD and others are working on. But I do think this is really a key area which requires thinking, and potentially some of the suggestions that Anna said, is there a way to think of some framework where hidden debt should be treated differently, both in legal and economic terms. Last point, which was, really bringing all stakeholders to do their part. And, a lot of the reforms we discussed today are not going to have any immediate impact. And we are in the middle of a pandemic, and we have countries, especially lower income countries, which participated in the DSSI. And from mobile phone surveys, we know that people are skipping meals, and it's really dire in some circumstances. So I think it is important that we take time to do, to work on these contractual improvements to affect the debt stock, but we also really focus on what can immediately help, which is a common restructuring approach encompassing all official bilateral creditors. This is currently being discussed at the G20 to come up with a common approach to restructuring official bilateral debts. I think this is going to go a long way, especially at this current juncture. Thank you.
Thank you very much, Ceyla and Rhoda. In 5 minutes or less, we need to move to our next panel, and a couple of our officials need to get to their next obligations. So I'm going to rapid fire shoot off some summaries of the questions that have come in from our participants over the Q&A function. One, based on something Carlos Carpi said, there was mention of the difficulties and limitations of the New York courts. There's the London courts. Is there any provision or possibility, and this I guess is more a question to the non-IMF discussants, in the bucket for having some kind of international court or alternative to the New York courts at this point? Or are we just stuck with whatever we get? Anna?
So, look, if ever there was a time for the UN Security Council to reprise what it did for Iraq, it would be in the case of a global pandemic. And so they had shielded Iraq's assets, and then there was national action afterwards. So I guess, look, I don't think we're looking at immediate prospects of a bankruptcy regime. But what I think we need to be thinking about, and this is why I'm so up about this information business, we need to think about adapting elements of bankruptcy, or whatever you want to call a consensus, collective, comprehensive debt treatment regime, which can then be adapted in national courts, et cetera, right? But if you have a single information platform, if you have shared norms that can proliferate, I think that can be disseminated through national channels. I don't think we're looking at an imminent international institution, but frankly, I think the next impetus for it is going to come from the private sector when they start worrying about official exposures. So I think we're going to see some realignment in this space.
Thank you. Now we have a question from Geoffrey Okamoto. I'm going to restate. We've talked a lot about legal framework and particular tax, but Peter, I'll put it to you. The Argentina restructuring was allowed to go ahead with the new bonds still issued under the old 2005 CACs instead of being updated. Is that correct? And why did that happen if the new CACs are an improvement?
I think this speaks to the diversity of creditor interests that Deborah and others touched upon. So certain creditor classes had, I don't want to say demands, but focused on preserving particular aspects of their existing structures. I want to point out, by the way, and Deborah made this point, I think we have and I'll do this briefly, but we have this intuition that it's better for all the creditors to be in one committee. And I think that's just fundamentally wrong. And because the problem is that given how dispersed the creditors are, and this is one example that bonds were issued under different indentures, their interests are not all aligned. And when you put them all together, even in 3 different groups, you have a lowest common denominator phenomenon where the group then can't decide what it wants, or it has to cave to the most extreme demand from its constituents. And that is not a good dynamic. So putting all of those disparate interests in one committee can lead to either inertia or just outrageous demands being driven by the most extreme creditor within the group who would threaten to leave if not given what he or she wants.
Thank you very much, Peter. Very clear. Let me put a last question to Deborah. You didn't mention, Peter did, the issue of the ratings agencies. With some insight into how the private creditors think. I mean, is there a role that they could be playing to make this situation easier? This question is based on Ted Truman. Would we want to see ratings go up more after a debt workout, or are we ready to push out the ratings agencies from these discussions? How do you see their role?
I think it's tricky. I think they've only done, what they're set up to do. I think people were a bit surprised, I think on the official sector side, by the reaction of the rating agencies to the DSSI and, the putting of some countries on negative outlook in anticipation of DSSI being taken up. And then even where those countries did not take DSSI up either on the official or private sector side, still looking at the rating from the perspective of likely pressure from the official sector on those countries eventually to take up DSSI. So I think, their evaluations can be quite subjective and can cause and sort of trigger implications for policy making that really need to be built into the policy making up front, because otherwise the policy making kind of suffers. And I think the biggest reason why DSSI of the private sector has faltered is because of the rating implications and potential accelerated loss of market access by countries that may be on the receiving end of sort of negative ratings steps. So it's, I think, something that we should look at as a community, at least to understand better also differences between the various rating agencies and how they look at these situations.
Thank you very much, Deborah. That concludes the first session of our mini conference on the fundamental issues of sovereign debt and private sector creditors, of course, prompted by the new report from the IMF in response to the G20 Working Group request, the International Architecture for Resolving Sovereign Debt Involving Private Sector Creditors. And as Ceyla and Rhoda stressed, they are offering policy options, not even policy proposals, or I shouldn't say not even, but carefully options, because this is meant to be the start of a discussion. We are grateful to the fund's leadership, including First Deputy Managing Director Geoffrey Okamoto, for letting Peterson host this first discussion of the new public work. We have a link to the paper on our website. It is available, of course, also at the IMF as part of the open discussion. I particularly want to thank Ceyla and Rhoda for doing such a great job of presenting the state of play, as well as their analysis, their team's analysis, and their views. And I want to thank Peter, Anna, and Deborah coming to this, bringing their expertise, their practical knowledge, and their forthright insights to this discussion. Unfortunately and fortunately, this is a discussion that did not get resolved today, but I do feel it got advanced. And I realize that's boilerplate, but People who watch Peterson Institute events know I don't usually say that. In this case, I genuinely do. And full credit to the fund's work on this paper. Let us now turn to our second panel, which is smaller, shorter, but still quite punchy. Olivier Blanchard, the C. Fred Bergston Senior Fellow at the Peterson Institute, of course, formerly President of the American Economic Association, still Robert Solow, Professor of Economics Emeritus at MIT, and most relevantly for today, beyond his general brilliance, spent 7 years as economic counselor and director of the research department at the IMF, will chair the next session with presentation by Jerome Zettelmeyer and discussion by Maurice Obstfeld. Olivier, please.
Good, thank you, Adam. And clearly the second session is a natural follow-up to the previous one, which is how many debt restructurings will we have to deal with in the coming years? So that's really the topic. What is the state of debt and how much we should worry? We have 30 minutes, so I'm going to be very, very quick. I'm going to introduce both Jeremy and Maury, and then let them speak. I hope we have time for Q&A at the end. I'm not so sure. We'll see. Jeremy is the deputy director of the SPR department at the fund. He's in charge of work on sovereign debt, so he's clearly the most qualified individual on the surface of the earth to talk about these issues. He's on leave from the Peterson Institute, sadly so. He has worked at the German ministry, he has worked at the EBRD, and he's actually my partner in crime on some of these issues. We have worked together on these issues. So there might be a conflict of interest here. I'll be quiet. The discussion doesn't need an introduction. It's Maurice Obstfeld, who has been a professor at Berkeley for a very long time. He was also my successor at the fund as chief economist and did a great job. And he's incredibly qualified to discuss these issues. Jeremy, go ahead.
Jeremy, we're not hearing you, so you may be muted. We can see your screen though.
Yes, apologies. You can hear me now, right?
Yes, we can. Thank you.
Great. Okay, well, thank you so much, Olivier, for this very nice introduction. And there's no conflict of interest because Olivier is always very tough to his former students. So you'll probably see that happening. So let me point out one big difference between the presentation I'm about to give and the previous one. So the previous one presented an IMF paper that was approved by IMF management, whereas this presentation is really just my personal opinion, even though it draws on discussions with many IMF colleagues, but this should not be attributed to the fund. So what I will try in this presentation is to give you a sense of, how bad might it get, and more generally, because I will not be able to answer that question in any precision, give you a sort of a way of thinking about the impact of the pandemic on sovereign debt and what that might imply for the types of debt crisis that we might be getting and for how to resolve them. So I'm going to structure it in three sections. I'm going to give you a few facts at the beginning. These are things that are happening right now or have already happened since March. Many of them well known, so I'll go quickly through that. I will then show you a few analytical results from various tools that one can use to answer the title question, namely what kinds of debt crisis might be ahead. And so those are basically divided into two categories, those looking at long-term debt sustainability, and then the results of some internal models at the fund that say something about short and medium term debt crisis risks. And then I will very briefly draw some implications from those models. So on the facts. So I'll give you the four main facts, which I'm about to show in some slides, just on one slide up front. So the first, the most obvious one is we are seeing and we are projecting very large increases in debt across the boards in all major country groups, particularly in advanced countries, but also in emerging markets and low-income countries. These large projected debt increases have already triggered a number of rating downgrades in both emerging markets, particularly in emerging markets and in some low-income countries. But somewhat surprisingly, we are not actually seeing an increase in debt restructuring, default events, debt distress, even a bit more broadly defined so far. So this is, in a sense, a puzzle. So the situation at this point is much less bad in the debt arena than we expected it to be in March. Now, why is this the case? Well, the presumed reason is because of official sector reactions, which have been, very swift, very decisive. And so the big two here are, on the one hand, the easing by all major advanced country central banks, and also quite a bit of activism by emerging market central banks, leading to relatively low financing costs for sovereigns across the board, also in emerging markets and in low-income countries that have market access. And the second, of course, is access to emergency financing from international financial institutions, the IMF emergency loans, MDBs, and the G20 debt service suspension initiative. So those have kept effectively borrowing costs low and relatively stable, and that has so far averted a crisis. Very recently, you can see an uptick in spreads, which I will show you at the end. So let me quickly go through. So this slide shows you the trajectory of general government primary balances since 2005 with the latest live WIO projections. So these are taken from the live WIO database. They were very close to the projections that will be published later in October in the WIO. And so the three solid lines are the median country with respect to primary balances. The shades around the solid lines, so the three median countries in each group, advanced economies, emerging markets, and low-income countries. The shading is the interquartile ranges. So this is basically the difference between the 75th percentile and the 25th percentile of the distribution of primary balances in each category. And so, the astonishing thing is this very large projected deficit for this year, larger than anything we have seen over this program, over this projection horizon, with then a recovery that is more or less in line with the projected recovery in output. Now, this is what this means for debt to GDP ratios. So here you can see, again, the three median countries now defined in terms of debt levels, much larger interquartile ranges reflecting very large dispersions in debt levels, particularly in advanced countries. And the numbers on the right side refer to the average change in debt. So this is, if you like, the change in debt for advanced countries as a group relative to GDP of the countries as a group. That's projected to be about 17% this year relative to last year. For emerging markets, we have about 8.5%. For low-income countries, about 7%. The interesting thing here is that for the advanced countries, it's essentially an upward shift that is not expected to come down very much within the period that we are projecting here. For emerging markets, you're seeing a little bit of reversion. This chart shows that the projected increase in debt is almost universal for all countries. So contrary to what the previous chart showed, these are not changes over time, but basically the vertical axis focuses on debt projections for 2021. And what it does, it compares the debt projections for 2021, which originally had in last year's October WIO, with those in the latest WIO. So the difference, the number on the vertical axis shows how much those debt projections have gone up with respect to 2021 debt. On the horizontal axis, we have the debt levels that we originally projected in the 2019 October WIO for debt in 2021. And basically the point of the chart is to show that first, almost all of these little bubbles are above zero in the vertical axis, so debt goes up, and then that it particularly goes up in countries that had high projected debt back in 2019. This is simply summarizing the numbers of downgrades for the three major rating agencies. You can see they're mostly in emerging market countries, and there are lots of them. So, you know, between 15 and 20 countries were downgraded. Okay, and now the point that, you know, we haven't really we haven't really hit a wall as far as debt distress is concerned yet. So these shows you sort of the main ongoing and very recently completed restructurings, and basically the ones on the left were already announced as restructurings before the pandemic hit. The only real major restructuring that was announced since the pandemic hit was the Ecuador restructuring. And here we have a similar picture for low-income countries. So these are countries that are rated as being in distress, in debt distress, because they have external arrears, or they are restructuring, or they're in default, or they're viewed as having clearly unsustainable debts, according to the IMF World Bank Sustainability Framework for low-income countries. And the astonishing thing is that, you know, these two lists are before and after the shock are virtually the same. So there's one country that was rated as unsustainable before the shock that dropped out. It's now rated as high risk of debt distress, but not in distress. And then we have one new entrant into the distress group, which is Zambia, which is trying to restructure its debts. But even Zambia was, you know, very, very close to debt distress even before the shock. Okay, so here's one reason why defaults might not have happened yet, and this is very easy financing conditions. So this shows the change in 10-year bond yields in advanced countries compared to what it was on the 1st of January in 2019 in points. And so, you know, it's been trending down. This is the sort of low for long phenomenon. And then you see this little spike here around March March. I don't know if you see my cursor. I'm trying to point to it. March of 2020. And that is sort of this brief moment of tightness in financial markets that comes with the realization that, yes, the pandemic is with us and it's going to be bad. And then that immediately goes away as a result of central bank actions. And so there's something parallel going on with emerging markets and low-income countries, only much more so. So this is the trajectory for emerging market yields. So these are not spreads, these are actual yields, these are borrowing conditions. So you have a huge increase, a very big spike in borrowing costs as a result of the pandemic. So this is the so-called sudden stop in capital flows in March, and it quite quickly goes away. Not as fast as in advanced markets, but as a result of these actions in advanced markets. And then, you know, as of June, it's been hovering around the levels that we had in the summer of last year, so pre-pandemic levels. Not quite as low as in January, but close. And then finally, we have the low-income countries, and those follow a very similar trajectory here. You know, it's more volatile, and it's actually dropped further. Okay, and then this one is this is sort of the caveat slide. So this shows now spreads, and it has a peculiar way of averaging the spreads. Rather than showing average levels of spreads, it shows the number of countries with spreads above 750 basis points in both the emerging markets and low-income country groups. So the groups are those that have that are cited in the MB, so they had or have market access. And so, you know, what you see is this very big spike in countries with MB spreads above 750 basis points. And the reason why that's interesting is because that's sort of what my MCM colleagues in the Monetary and Capital Markets Fund, Department of Fund tell me is sort of a reasonable proxy for loss of market access, right? And so by this proxy, the number of countries that lost market access really jumps in March from about 6 emerging markets to like 27. And it stays there. It doesn't stay there for very long, though. It stays there until June, roughly. And by the 1st of June, more or less, we have these numbers come down very significantly and sort of hover around 10. And only very recently have we seen some widening in spreads, and several countries, I think that would be about 3, go back above this critical threshold. Okay, So now to the analytical part. So again, I'm going to give you the main results just on one slide, so you get the message and you know, don't get caught up in technical details. So there are two somewhat contradictory results. So one is that based on the baseline projected public debt rises. So these are large public debt rises, but they are baseline, and you know, they clearly are not relevant if we see a very protracted pandemic or another bad rises. So given these projected public debt rises that I showed you before, the impact of the crisis on long-term debt sustainability for most countries is expected to be modest. And the intuition for that, as I will show you, is that long-term debt sustainability depends both on the debt that you have to pay off, and it depends on the difference between the real interest rate at which you have to pay off the debt and the growth rate, right? Because the growth rate of your country determines how fast the denominator in the debt to GDP ratio will rise. And so it turns out that this difference is very small for most countries. It's close to zero. In some cases, it's negative. And because of that, you're multiplying this large rise in debt with a very small number. And so the projected debt stabilizing primary surplus actually will not change very much. Now, I hasten to add several caveats. So this is, again, projected public debt rises. It does not include contingent liabilities. So to the extent that you think that the true number, say, for a country is not 20% increase in debt, but 40%, because it's going to have to bail out its financial system, or because there are all these guarantees that it did during the pandemic, you're going to get a bigger increase in the adjustment need. But even then, it would be multiplied with a very small number. So to give you an intuition, if you know the difference between the real interest rate and the growth rate is 1%, so you have a real interest rate of, say, 2% and a growth rate of 1%, and debt rises by 20 percentage points, which is sort of the ballpark that we are in advanced countries, then the increase in the debt stabilizing primary balance is going to be 0.2% of GDP. So say from 1 point surplus that you have to run permanently to 1.2% of GDP surplus. Now, if you think that debt is going to rise by 40 points of GDP, it would rise from 1 point of GDP to 1.4% of GDP. So it's more of an adjustment, but it's still a small adjustment. The more relevant, the scariest thing that can happen is that the pandemic somehow affects not just growth output levels, but the long-term potential growth rate. If that's the case, then indeed it would have a very big impact on public debt sustainability, but it's very difficult to see how that could be the case. So this is sort of point number one, is, if you like, a relatively sanguine conclusion. Now, at the same time, all our models and all our desk economists are telling us that the increase in the risk of debt crisis over the short and medium term, so we're talking between 1 and 5 years, is going to be very high. So how do you resolve this tension? Well, the intuition is that even though the debt stabilizing primary balance is not going to go up by much, because of these very large deficits that you're going to have to finance over several years, and you cannot adjust it very quickly, you're going to have very large funding needs over the short and medium term. And that basically sets you up for a crisis, because if there are changes either in international funding conditions or losses of confidence, you lose market access, then you're in trouble, because then you have to do this very large adjustment in a very short time, unless you restructure your debts, right? So that's essentially the bottom line of this story. Now, very quick, a few charts.
You have about 2 minutes. You have about 2 minutes left.
Okay, I'm gonna flip through these charts. This shows the scatter plot shows the projected changes in the debt to GDP ratio. The next chart shows the, corresponding increase in the debt stabilizing primary balance. And the whole point here is it hugs the axis. So the one axis, the horizontal one, shows the primary balance projection for 2021 that would stabilize the debt as we projected it based on October 2019 WEO data. The vertical axis shows the corresponding projection. Again, we're referring to the debt stabilizing primary balance in 21 based on the latest WEO. And basically, they're almost the same. And on average, actually, they have gone slightly down because of some of these negatives, R minus Gs. Now, having said that, and that's sort of my third point, The adjustment need that we are projecting for 2021, which is the difference between the projected debt stabilizing primary balance and the projected actual primary balance in 2021. So how far you're going to have to reduce your deficit to be able to stabilize the debt starting in 2021. That thing has gone up a lot, right? So it's gone up by about 4 points of GDP in advanced economies, by about 3 points of GDP in market access countries, in emerging markets. And it was already pretty high in many of these countries before the crisis. And so you're going to have adjustment needs somewhere between 0 and 15 points of GDP after the crisis. And that's what makes the whole thing dangerous. Okay, quick, just 2 results from some models. This is from a Logit model that is basically an early warning system, has all kinds of fundamentals on the right-hand side, and then it projects debt distress events, not necessarily restructurings, but distress events, which also include, IMF programs that resolve debt problems. And the main result here is that the average probability of debt distress in the next 2 years has roughly doubled, a little more than doubled, from about 11% to 24%. And then the final point is, this is from an internal early warning system. It's called the fiscal vulnerability exercise, that shows the proportion of advanced economies and emerging markets that are viewed either at risk of high risk or moderate risk of debt distress. And so here the number of countries that are viewed as high risk of debt distress in advanced economies has gone up from about 3 countries to 8 as a result of the pandemic, and in emerging markets from 15 to 35. Okay, so to conclude, the pandemic crisis is going to lead to some additional cases of long-term unsustainable debt. We expect few of those because of the first set of arguments that I made, but certainly some, because if you were already close to being unsustainable, you might have been pushed over the edge by the pandemic. But then we also expect several additional debt crises. I mean, I hesitate to use the word many, but a significant number of debt crises as a result of the increased funding needs and the risks that go with that. And so in the first of these cases, the solution, if you are unsustainable, is to do a preemptive restructuring combined with some reform and adjustment, right? Now, the danger is you're going to wait too long, conditions will deteriorate, and then you're going to end up defaulting. In the case of just a plain old debt crisis where you may or may not be unsustainable, again, the solution might be, in some cases, a preemptive debt restructuring when you need that space to help you do adjustment. Some cases you may not need any restructuring at all. You may just be able to get additional financing and reform and adjust. But again, if you mess it up, you wait too long, you're going to end up with defaults. And so in some sense, the role of policy should be viewed as steering countries into these 2 middle groups. How can we do this? This is my last slide. Well, there are 2 main challenges. The first is, as I said before, the main reason why we don't have debt crises so far, to a much greater extent than we had them or we would have had them, is because financing conditions were pretty easy. So we don't want to abruptly increase financing conditions. On the other hand, if we keep financing very easy, that also creates an incentive not to recognize the need to do adjustment and in some cases preemptive restructuring, right? So there's a very careful balance between giving extra financing and creating incentives to recognize and address debt vulnerabilities. And so this is one of the main problems, the challenges that we will have to navigate when we think on what terms the debt service suspension initiative of the G20 is extended. And then the final point is that, of course, we need an efficient preemptive restructuring framework. The message of the paper that was presented earlier is that we actually have a pretty good framework, but with some room for improvement. Now, an area that the paper did not discuss is the official creditor world. And so here, the main fact is that we have very large creditors that are not in the Paris Club. So having a common framework for those creditors with Paris Club creditors would be very desirable. Thank you, Olivier. Sorry for running over.
Thank you, Jeremy. Maury.
Great. Well, it's a pleasure to be here at this virtual IMF conference hosted by Peterson. Well, if you look back to where we were in March, there were expectations of massive distress in emerging markets given the capital flow reversal that we were seeing. But following massive central bank stimulus, notably by the Fed, capital flows reversed. And as China and advanced economies moved to reopen, economic activity rebounded to some extent, of course, in some countries more quickly than others. The emerging market debt landscape remains quite worrisome, but as Geoffrey pointed out in his excellent presentation, we have not yet seen the meltdown that we would have expected possibly to occur 6 months ago. Of course, vast uncertainties remain, and Geoffrey tries to quantify these to some extent. Most importantly, the prospects for emerging market growth are hazy. Geoffrey made the fairly strong statement that we wouldn't expect a change in long-run growth. I'm not sure, though, that we wouldn't see a persistent change. The prospects for
there's a clicking sound. You're the only one who has a mic on, so I don't know whether it's something. Just keep going. But if you know what it is,
yeah, it may be me knocking against my mic. The prospects for advanced economy growth are also relevant, and an uneven return of advanced economy growth relative to emerging market growth would create, obvious tensions and ambiguities. The progress of the disease, which we have not talked about very much, is quite relevant, including when a vaccine is available and what might be the prospects for widespread distribution to emerging and low-income countries. And finally, we shouldn't discount the role of politics. The capacity for traumatic economic events such as the current one to generate big and not always favorable changes. As Geoffrey pointed out, there are two basic results here. The result on long-term sustainability and the results on short-term risks. Is the clicking gone away? Are we okay now, Olivier? Okay, great, sorry. A lot hinges on what happens to R minus G. That was also a theme in Olivier's presidential address to the AEA. And in Geoffrey's telling, R minus G doesn't change much, maybe even goes down a little. And that means that even though debt income ratios are projected to be higher, there's not much of an impact on long-term sustainability. He does make the important point, though, and this would be the first caveat I would raise, is that you may need a big change to get to long-term sustainability of the primary balance, given where primary balances are today. And I would just suggest that because that is going to take time, perhaps a long time, in that process, debt income ratios will continue to increase. And it may be that the WEO live forecasts for 2021 are not the most relevant ones for us to be considering. I also wonder about the role of interest rates. And let me just try to share my screen and put up just one slide. Can people see this slide? One important empirical regularity has been that since the global financial crisis, we have not seen, at least did not see up until 2019, a fall in emerging market interest rates commensurate with what we saw in advanced economies. Where we are going to go in the next few years is unclear, but we should worry about this. What about long-run growth? Again, I made the point that it may take a while to return to long-run growth rates prior to this pandemic, but it may also be the case that fiscal stimulus is needed to get there, more fiscal stimulus than we have at the moment. And that in the absence of that fiscal stimulus, perhaps because governments are reluctant to set off debt crises, growth lags over time. this could set up a very negative dynamic. As Geoffrey rightly points out, financial conditions have been somewhat accommodative, but looking at his slide 11, I'm not impressed with what we see on long-term interest rates. They're not really much lower relative to the summer of 2019, for example, yet growth prospects are clearly more negative, given that we're still in the middle of the pandemic. It may be that there's a Powell put in play that is supporting financial conditions, but it's not clear that that's going to be in effect without limit, particularly as conditions improve, as we hope they will, in the United States. A last caveat I would mention is that one of the striking aspects of the current emerging market situation is the number of countries which have allowed their currencies to depreciate markedly, again, since roughly the summer of 2019. These would include, Brazil, Chile, Colombia, Mexico, Russia, South Africa, Turkey. This has not been so evident in Asia, but certainly across a large range of other emerging markets, currencies have fallen. And this raises the question of the net impact over the longer term. There may be an effect on net exports. The literature on dominant currency pricing should make us worry a bit. Are there financial stability implications that may become more evident over time due to dollar-denominated debts, particularly in the private sector? So I do wonder about long-term sustainability. We shouldn't be that confident. On short-term sustainability, Geoffrey presents a couple of approaches which are quite interesting. One key finding is that over the short-term horizon of roughly 2 years, the probability of stress, as he defines it, slightly more than doubles. I think one thing we should note is that while Geoffrey emphasized the average response across countries, there's a huge amount of variability in the outcomes for individual countries. Now, we didn't see identifiers for those countries, not surprisingly, but there are a number of countries where the probability of short-term distress was low and now has become exceedingly high. And those, I assume, are countries that are receiving a lot of attention in SPR. Driving his results are basically 3 key variables: debt to income, and the VIX. And while it's true that the VIX has been somewhat elevated compared to pre-pandemic levels, I'm not sure if that's really the best indicator. There's a number of recent studies, there's a surprisingly wide range of recent studies which show that the power of the VIX to capture financial distress and market turbulence is not what it was years ago. One study I would cite is a recent update by Forbes and Warnock in their work on capital flow surges. And what they show is that while the VIX was a very important driver of capital flow surges and retractions historically, that has been less the case over the last decade or so. The VIX also does not play a role in measures of limits to arbitrage, such as covered interest parity in recent years.
Maury, I'm sorry to squeeze you. We're 5 minutes beyond schedule. Maybe you take 1 or 2 minutes more.
Sure. Let me just mention one other point about the Logit results, and then I'll wrap up very quickly. Clearly, short-term stress raises the possibility of multiple equilibria. And I do wonder how we can capture that and capture the fact that, particularly in this COVID environment, such multiple equilibria might be correlated across countries. I think the VIX tries to get at this, but there may be other variables we could enter. I wonder about the role of the downgrades that Geoffrey showed. Last point I want to make, policy conclusions are sensible. There is the problem of knowing unsustainable debts when we see them. And here the fund's DSAs are incredibly important. It has been a problem, as Deborah hinted at in our last segment with respect to the example of Argentina, to actually, credibly find possibilities of unsustainability with the DSA process. Politics do come into this, and one would hope that one positive result of the kind of rethinking and the sorts of reforms and changes that the IMF is recommending we think about might be to make the restructuring process easier, which in equilibrium might lead to more of a willingness to make DSAs more pessimistic when that is in fact warranted. And I'll just stop there.
Given the time, I suspect that unless Jerome has something absolutely essential to say, I'll just conclude. There was a number of questions on the chat. I would advise the people who ask them to actually ask them directly to Jerome bilaterally. I do apologize, but I suspect that we really have to end this session now. Adam, any last words?
No, just as you said, Olivier, the update on what is the state of the sovereign debt crises, we might reasonably expect to see several, if not many, as Jeremy, I think, put it, was the natural follow-on, and it's good to see our former and we hope eventually future colleague leading work on the analytical side of this at the fund. Thanks to Maury for getting up so early California time to provide his views, which were, as always, very insightful. Once again, just to remind everyone that the fund has released their new paper on policy options for international sovereign debt in relations to private creditors. The paper is available on the PIIE website, the IMF website. We will have very shortly the videos of this immediate past discussion with Olivier, Jeremy, and Maurice, but also the videos of Rhoda, Ceyla, Peter, Anna, and Deborah. Thank you all for your participating. This meeting is adjourned.
Thank you so much. Bye-bye.
Thank you.